open a ZERODHA account. Chapter 9. The Nifty Futures. 9.1 Basics of the Index Futures. Within the Indian derivatives world, the Nifty Futures has a very special place. The Nifty Futures is the most widely traded futures instrument, thus making it the most liquid contract in the Indian derivative markets. In fact, you may be surprised to know that Nifty Futures is easily one of the top 10 index futures contracts traded in the world. Once you get comfortable with futures trading, I would imagine, like many of us, you too would be actively trading the Nifty Futures. For this reason, it would make sense to understand Nifty Futures thoroughly. However, before we proceed any further, I would request you to refresh your memory on the index. We have discussed the same here. I assume you are comfortable with the basic understanding of the index. Therefore, I will proceed to discuss the index futures or the Nifty Futures. As we know, the futures instrument is a derivative contract that derives its value from an underlying SO. In the context of Nifty Futures, the underlying is the index itself. Hence, the Nifty Futures derives its value from the Nifty Index. This means if the value of Nifty Index goes up, then the value of Nifty Futures also goes up. Likewise, if the value of Nifty Index declines, so would the Index Futures. Here is the snapshot of Nifty Futures contract. Like any other futures contract, Nifty Futures is also available in 3 variants: current month, mid-month, and far month. I have highlighted the same in red for your reference. Further, in blue I have highlighted the Nifty Futures price, which at the time of taking this snapshot was 8,631 rupees per unit of Nifty. The corresponding underlying value, index value in spot, was Rs. 8,602.29. Of course, there is a difference between the spot price and the futures price, which is due to the futures pricing formula. We will understand the concepts related to futures pricing in the next chapter. Further, if you notice, the lot size here is 25. This has been reduced to 25 from 50. We know the contract value is CV equals futures price asterisk lot size equals 8,631 asterisk 25 equals 215,775 rupees per. Here are the margin requirements for trading Nifty Futures. I've used zero to margin calculator to get the margin values. Order type margin: NRML 17,323 rupees per. MIS 6,937 rupees per. BO and CO 6,233 rupees per. These details should give you a basic overview of the Nifty Futures. One of the main features of Nifty Futures that makes it so popular is its liquidity. Let us now proceed to understand what liquidity is and how one would measure it. 9.2 Impact Cost. You would often hear the term liquidity while trading the markets. Liquidity is the ease at which one can buy or sell a particular stock or futures. If a stock is highly liquid, read it as very easy to buy, sell, then it would attract seasoned traders to trade in large quantities at ease, without really affecting the stock prices. A highly liquid stock contract invariably attracts a lot of institutional interest as well. Besides, if stock futures is highly liquid, then it usually translates to lesser volatility. Most importantly, if the stock is liquid, then placing a market order is hassle-free. Let us take up the example of MRF Limited to understand liquidity. Assume a foreign institutional investor intends to buy 5,000 shares of MRF Limited. As you may know, MRF Limited is probably the most expensive stock in terms of price and not valuation in the Indian markets. MRF stock is currently trading at 38,351 rupees per share. Therefore, buying 5,000 shares at this price would translate to a transaction worth around 20 Rs 38,351 asterisk 5,000. Do note, a transaction of 20 CRS is not really a large one for a typical foreign institution. Anyway, given that they want to buy 5,000 shares, let us look into MRF's liquidity in the market. Here is the snapshot of MRF Limited's order book. Market depth is taken from NSE India website. If you wish to buy large quantity of shares, then you need to look at how many shares are being offered in the market. As you can see from the snapshot above, there are only about 4,313 shares in the market, highlighted by blue arrow. Clearly, the number of shares in the market is lesser than what is required. Hence, the MRF counter is considered shallow or illiquid. Liquidity can also be measured by looking at the bid-ask spread and estimating the impact cost. Knowing about the impact cost is particularly helpful while placing a market order. Impact cost is the loss associated by executing a round-trip trade. The loss is expressed as a percentage of the average of the bid and ask price. Round-tripping is an instantaneous arbitrary trade you carry out by buying at the first best available sell price and selling at the first best available buy price. Let us execute this on MRF. Please refer to the order book snapshot above. Buy price 38,364 rupees and 95 paise. Sell price 38,266 rupees and 25 paise. So if I were to do a round trip, I would clearly lose money on it. In fact, all round trip trades result in a loss. The loss in this case would be equals 38,364.95 to 38,266.25 equals Rs 98.7. Further, the average of bid and ask is calculated as follows: equals 38,364.95 plus 38,266.252 equals 38,315 rupees and 60 paise. Hence, the impact cost would be equals round trip loss average of bid ask spread equals 98.7, 38,315.6, approximately 0.3%. So how do you use this information? Well, it simply means if you were to place a market order to either buy or sell the stock, you are likely to lose 0.3% due to impact cost. This may not always be true, but you need to be aware that based on the number of shares you wish to transact in, you are likely to lose about 0.3% owing to impact cost while placing a market order. Next time you call your broker to buy or sell a stock at market, the price you see on your screen and the price at which the trade executes may vary. Do remember this is attributable to the impact cost. Now, a 0.3% loss due to impact cost is extremely high. To give you a perspective, let us run through the same exercise on Nifty futures. Price at which you can buy equals Rs 8,769.9. Price at which you can sell equals Rs 8,768.8. Round trip loss equals Rs 1.1, 8,769.9 to 8,768.8. Average of bid ask equals 8,769.9 plus 8,768.82 equals 8,769.35. Impact cost equals 1.1, 8,769.35 equals 0.0125%. This means if you buy or sell Nifty futures at market price, you are likely to lose just about 0.0125%. Contrast Nifty's impact cost of 0.0125% with MRF's impact cost of 0.3% and you will know the importance of liquidity. The few key messages that I want you to take away from this discussion are these. Impact cost gives a sense of liquidity. The higher the liquidity in a stock, the lesser is the impact cost. The spread between the buying and selling price is also an indicator of liquidity. Higher the spread, the higher the impact cost. Lower the spread, the lower is the impact cost. Higher the liquidity, lesser the volatility. If the stock is not liquid, placing market orders is not a great idea. Considering Nifty futures is the most liquid contract in India, it is safe to set 0.0125% as a benchmark for impact cost. Going by this, MRF's 0.3% is way higher than Nifty's impact cost, hence it is right to say that MRF is highly illiquid. You may also be interested to know that besides Nifty futures there are a few other future contracts that are quite liquid in the Indian markets, such as the Bank Nifty futures, Reliance Industries, Tata Motors, SBIN, Infosys, TCS, ITC, DLF, Cipla, etc. Maybe you can calculate the impact cost for a few of these futures contracts to get a sense of their liquidity. 9.3 Why trading Nifty makes sense. As you know, the Nifty index is a basket of 50 stocks. These stocks are selected to represent a wide section of the India economic sectors. This makes Nifty a good representative of the broader economic activity in India. This naturally means if the general economic activity is going up or at least expected to go up, then Nifty's value also goes up, and vice versa. This also makes trading Nifty futures a much better choice as compared to single stock futures. There are many reasons for this. Here are some. It is diversified. At times, taking a directional call on a single stock can be a tough task. This is mainly from the risk perspective. For example, let us just say I decide to buy Infosys Limited with the hope that the quarterly results would be good. In case the results don't impress the markets, then obviously the stock would take a knock and so would my P&L. Nifty Futures, on the other hand, has a diversified portfolio of 50 stocks. As it is a portfolio of stocks, the movement of the index does not really depend on a single stock. Of course, occasionally a few stocks, index heavyweights, can influence Nifty to some extent, but not on an everyday basis. In other words, when you trade Nifty futures, you completely eliminate unsystematic risk and deal only with systematic risk. I know these are new jargons being introduced here. We will discuss these terms in more detail at a later stage when we talk about hedging. Hard to manipulate. The movement in Nifty is a response to the collective movement in the top 50 companies in India by market capitalization. Hence, there is virtually no scope to manipulate the Nifty index. However, the same cannot be said about individual stocks. Remember Satam, DHCL, Bhushan Steel, etc. Highly liquid, easy fills. Less slippage. We discussed liquidity earlier in the chapter. Since the Nifty is so highly liquid, you can literally transact any quantity of Nifty without worrying about losing money on the impact cost. Besides, there is so much liquidity that you can literally transact any number of contracts that you wish. Lesser margins. Nifty futures require much lesser margins as compared to individual stock futures. To give you a perspective, Nifty's margin requirement varies between 12 to 15%. However, individual stock margins can go as high as 45 to 60%. Broader economic call. Trading the Nifty futures requires one to take a broad-based economic call, rather than company-specified directional calls. From my experience, doing the former is much easier than the latter. Application of technical analysis. Technical analysis works best on liquid instruments. Liquid stocks are hard to manipulate. Hence, they usually move based on the demand-supply dynamics of the market, which obviously is what ATA mainly relies on. Less volatile. Nifty futures are less volatile compared to individual stock futures. To give you perspective, the Nifty futures has an annualized volatility of around 16 to 17%. Whereas individual stocks like say Infosys has annualized volatility of upwards of 30%. Key takeaways from this chapter. Nifty futures derives its value based on the Nifty index in spot, which is its underlying. At present, the Nifty futures lot size is 25. The Nifty futures is the most liquid futures contract in India. Just like other future contracts, Nifty futures contracts are also available with 3 different expiry options: current month, mid-month, and far month. A round-trip trade is an arbitrary, quick, instantaneous trade which involves buying at the best available sell price and selling at the best available buy price. A round-trip trade always results in a loss. Impact cost measures the loss of a round trip as a percent of average of bid and ask. Higher the impact cost, lesser the liquidity, and vice versa. When you place a market order to transact, you may lose some money owing to impact cost. Nifty has an impact cost close to 0.0125%, which makes it the most liquid contract to trade. 166 responses. Open a ZERODHA account. Chapter 10. The Futures Pricing. 10.1 The Pricing Formula. If you were to take a conventional course on futures trading, you would probably be introduced to the futures pricing formula right at the very beginning of the course. However, we have deliberately opted to talk about it now, at a much later stage. The reason is simple. If you are trading futures based on technical analysis, I assume a vast majority of you are doing this, then you would not really need to know how the futures are priced, although a good working knowledge would help. However, if you aspire to trade futures by employing quantitative strategies such as calendar spreads or index arbitrage, then you certainly need to know this. In fact, we will have a module dedicated to trading strategies where we would discuss some of these strategies. Hence, the discussion in this chapter will lay down a foundation for the forthcoming modules. If you recall, in some of the earlier chapters occasionally we discussed the futures pricing formula as the prime reason for the difference between the spot price and the futures price. Well, I guess it is time now to lift the veil and introduce the future pricing formula. We know the futures instrument derives its value from its respective underlying. We also know that the futures instrument moves in sync with its underlying. If the underlying price falls, so would the futures price and vice versa. However, the underlying price and the futures price differs and they are not really the same. To give you a perspective as I write this, Nifty spot is at 8,845.5, whereas the corresponding current month contract is trading at 8,854.7. Please refer to the snapshot below. This difference in price between the futures price and the spot price is called the basis or spread. In case of the Nifty example below, the spread is 9.2 points, 8,854.7 to 8,845.5. The difference in price is attributable to the spot future parity. The spot future parity, the difference between the spot and futures price that arises due to variables such as interest rates, dividends, time to expiry, etc. In a very loose sense, it is simply as a mathematical expression to equate the underlying price and its corresponding futures price. This is also known as the futures pricing formula. The futures pricing formula simply states futures price equals spot price asterisk 1 plus RFD, where RF equals risk-free rate, D, dividend. Note: RF is the risk-free rate that you can earn for the entire year, 365 days. Considering the expiry is at 1, 2, and 3 months, one may want to scale it proportionately for time periods other than the exact 365 days. Therefore, a more generic formula would be futures price equals spot price asterisk 1 plus RF asterisk X 365D, where X equals number of days to expiry. One can take the RBI's 91-day Treasury bill as a proxy for the short-term risk-free rate. You can find the same on the RBI's homepage, as shown in the snapshot below. As we can see from the image above, the current rate is 8.3528%. Keeping this in perspective, let us work on a pricing example. Assume Infosys spot is trading at 2,280.5 with 7 more days to expiry. What should Infosys' current month futures contract be priced at? Futures price equals 2,280.5 asterisk 1 plus 8.3528%, 7/365 0. Denote: Infosys is not expected to pay any dividend over the next 7 days. Hence I have assumed dividend is 0. Solving the above equation, the future price turns out to be 2,283. This is called the fair value of futures. However, the actual futures price, as you can see from the image below, is 2,284. The actual price at which the futures contract trades is called the market price. The difference between the fair value and market price mainly occurs due to market costs such as transaction charges, taxes, margins, etc. However, by and large, the fair value reflects where the futures should be trading at a given risk-free rate and number of days to expiry. Let us take this further. and figure out the futures price for mid-month and far-month contracts. Mid-month calculation. Number of days to expiry equals 34 as the contract expires on the 26th of March 2015. Futures price equals 2,280.5 asterisk 1 plus 8.3528% 34,365 0 equals 2,299. Far month calculation. Number of days to expiry equals 80 as the contract expires on the 30th of April 2015. Futures price equals 2,280.5 asterisk 1 plus 8.3528% 8,365 0 equals 2,322. From an SE website, let us take a look at the actual market prices. Snapshot of Infosys' mid-month contract. Snapshot of Infosys' mid-month contract. Clearly there is a difference between the calculated fair value and the market price. I would attribute this to the applicable costs. Besides, the market could be factoring in some financial year-end dividends as well. However, the key point to note is as the number of days to expiry increases, the difference between the fair value and market value widens. In fact, this leads us to another important commonly used market terminology, the discount and the premium. If the futures is trading higher than the spot, which mathematically speaking is the natural order of things, then the futures market is said to be at premium. While premium is a term used in the equity derivatives markets, the commodity derivatives market prefer to refer to the same phenomenon as contango. However, both contango and premium refer to the same fact: the futures are trading higher than the spot. Here is a plot of Nifty spot and its corresponding futures for the January 2015 series. As you can see, the Nifty futures is trading above the spot during the entire series. I specifically want to draw your attention to the following few points. At the start of the series, highlighted by a black arrow, the spread between the spot and futures is quite high. This is because the number of days to expiry is high, hence the X365 factor in the futures pricing formula is also high. The futures remained at premium to this spot throughout the series. At the end of the series, highlighted by a blue arrow, the futures and the spot have converged. In fact, this always happens, irrespective of whether the future is at a premium or a discount. On the day of the expiry, the futures and spot will always converge. If you have a futures position and if you fail to square off the position by expiry, then the exchange will square off the position automatically and it will be settled at the spot price as both futures and spot converges on the day of the expiry. Not always does the futures trade richer than the spot. There could be instances, mainly owing to short-term demand and supply imbalances, where the futures would trade cheaper than its corresponding spot. This situation is when the futures is said to be trading at a discount to the spot. In the commodities world, the same situation is referred to as the backwardation. 10.2 Practical application. Before we conclude this chapter, let us put the futures pricing formula to some practical use. Like I had mentioned earlier, futures pricing formula comes very handy when you aspire to trade employing quantitative trading techniques. Please note, the following discussion is only a preview window into the world of trading strategies. We will discuss all these things plus more in greater detail when we take the module on trading strategies. Consider this situation. Wipro spot equals 653. RF 8.35%. X equals 30. D equals 0. Given this, the futures should be trading at futures price equals 653 asterisk 1 plus 8.35% 3,365 0 equals 658. Accommodate for market charges. The futures should be trading in and around 658. Now what if instead the futures contract is trading at a drastically different price? Let's say 700. Clearly there is a trade here. The difference between the spot and futures should ideally be just 5 points. But due to market imbalances, the difference has shot up to 47 points. This is a spread that we can capture by deploying a trade. Here is how one can do this, since the future contract is trading above its fair value. We term the futures market price as expensive relative to its fair value. Alternatively, we can say, the spot is trading cheaper with respect to the futures. The thumb rule in any sort of spread trade is to buy the cheaper asset and sell the expensive one. Hence, going by this, we can sell Wipro futures on one hand and simultaneously buy Wipro in the spot market. Let us plug in the numbers and see how this goes. Buy Wipro in spot at 653. Sell Wipro in futures at 700. Now we know that on the expiry day, both the spot and the futures converge into one single price. Refer to the Nifty graph posted above. Let us assume a few random values at which the futures and the spot converge: 675, 645, 715, and identify what happens to the trade. Expiry value: spot trade P&L, long, futures trade P&L, short, net P&L. 675 to 653 equals plus 22, 706.75 equals plus 25 plus 22 plus 25 equals plus 47. 645 to 653 equals 08, 706.45 equals plus 55, 08 plus 55 equals plus 47. 715 to 653 equals plus 62, 715 equals minus 15 plus 6215 equals plus 47. As you can notice, once you have executed the trade at the expected price, you have essentially locked in the spread. So irrespective of where the market goes by expiry, the profits are guaranteed. Of course, it goes without saying that it makes sense to square off the positions just before the expiry of the futures contract. This would require you to sell Wipro in spot market and buy back Wipro in futures market. This kind of trade between the futures and the spot to extract and profit from the spread is also called the cash and carry arbitrage. 10.3 Calendar spreads. The calendar spread is a simple extension of the cash and carry arbitrage. In a calendar spread, we attempt to extract and profit from the spread created between two futures contracts of the same underlying but with different expiries. Let us continue with the Wipro example and understand this better. Wipro spot is trading at equals 653. Current month futures fair value 30 days to expiry equals 658. Actual market value of current month futures equals 700. Mid-month futures fair value 65 days to expiry equals 663. Actual market value of mid-month futures equals 665. From the above example, clearly the current month futures contract is trading way above its expected theoretical fair value. However, the mid-month contract is trading close to its actual fair value estimate. With these observations, I will make an assumption that the current month contract's basis will eventually narrow down and the mid-month contract will continue to trade close to its fair value. Now, with respect to the mid-month contract, the current month contract appears to be expensive. Hence, we sell the expensive contract and buy the relatively cheaper one. Therefore, the trade setup would require me to buy the mid-month futures contract at 665 and sell the current month contract at 700. What do you think is the spread here? Well, the spread is the difference between the two future contracts, i.e. 700 to 665 equals 35 points. The trade setup to capture the spread goes like this. Sell the current month futures at 700. Buy the mid-month futures at 665. Do note, because you are buying and selling the same underlying futures of different expiries, the margins are greatly reduced as this is a hedged position. Now, after initiating the trade, one has to wait for the current month's futures to expire. Upon expiry, we know the current month futures and the spot will converge to a single price. Of course, on a more practical note, it makes sense to unwind the trade just before the expiry. Let us arbitrarily take a few scenarios as below and see how the P&L pans out. Expiry value: current month P&L, short, mid-month P&L, long, net P&L. 660 700 to 660 equals plus 40, 660, 665 equals minus 5 plus 40, 5 equals plus 35. 690 700 to 690 equals plus 10, 690, 665 equals plus 2, 5 plus 10 plus 25 equals plus 35. 725 700 to 725 equals minus 25 725 to 665 equals plus 60, 25 plus 60 equals plus 35. Of course. Do recall the critical assumption we have made here is that i.e. the mid-month contract will stick close to its fair value. From my trading experience, this happens most of the times. Most importantly, please do bear in mind the discussion with respect to spreads in this chapter is just a sneak peek into the world of trading strategies. We will discuss these strategies in a separate module which would give you an in-depth analysis on how one can professionally deploy these strategies. Key takeaways from this chapter. The futures pricing formula states that the futures price equals spot price asterisk 1 plus RF x 365D. The difference between futures and spot is called the basis or simply the spread. The futures price as estimated by the pricing formula is called the theoretical fair value. The price at which the futures trade in the market is called the market value. The theoretical fair value of futures and market value by and large should be around the same value. However, there could be slight variance mainly due to the associated costs. If the futures is rich to spot, then the futures is said to be at premium, else it is said to be at a discount. In commodity parlance, premium equals contango and discount equals backwardation. Cash and carry is a spread where one can buy in the spot and sell in the futures. Calendar spread is an extension of a cash and carry where one buys a contract and simultaneously sells another contract with a different expiry but of the same underlying. 238.